The inflation scenario should improve provided that tariffs and increasing oil prices from the war in the Middle East don't move their way through in an inflationary fashion. We will recover earlier because we entered into a recession earlier. The one thing that isn't resilient is the U.S. dollar. We're actually seeing a decrease in the non-permanent residents, and our winter population growth was basically the lowest and Calgary was the fastest growing city on earth. Rental market has seen record high weekly new rental listing volume for all but 1 week this year. This gap, I don't think, is ever going to get any smaller than it is right now. In BC, we have a decreasing number of buyers because people are leaving. People in Ontario and BC are overlevered. They can't afford it anymore, and a lot more people are selling, and fewer people are buying. The number of people per dwelling is actually increasing in Canada. So the square footage per capita, let's call it, is actually decreasing.
Okay, great. I'll just welcome everybody to our monthly market breakdown with Real Estate Magazine and with Daniel Foch of Valerie Real Estate doing his monthly presentation. Just a reminder, everyone, please submit your questions. I'll be moderating those and asking Daniel your questions. So you don't have to wait till the end. You can ask your questions whenever you have them. So without further ado, I'll hand it over to you, Daniel.
Awesome. Yeah, thanks for having me. And yeah, anybody who has any questions, I typically prefer for this to be more of a conversation than a presentation. So feel free to interrupt me if I'm not explaining something properly, or if you have a question or would like me to expand on anything. I'm happy to do that. And Courtney's excellent at kind of translating some of the stuff from the chat to get it over to me. Um, and I did send a request to get that backup recording. Looks like we're good now. Okay, it should be rolling. Okay.
Great.
So, sorry, you can see my slides here.
Yep.
Okay, perfect. All right, yeah. So this is the June edition of the monthly market call. I used to be doing two of these, and we just decided to combine forces. So we basically have kind of combined the GTA market call with the national market call. So we'll be covering a handful of different things. We'll be covering what's happening with house prices, and then also the trade war, the non-trade war, just the war, interest rates, employment market, the housing market, GTA condos, which are really just something that a lot of people are paying attention to right now, as well as immigration and kind of potential recession scenario that's forming. A little bit about myself. My name's Daniel Foch. I am Chief Real Estate Officer at a company called Valerie.ca. I also host Canada's #1 real estate podcast. And I co-founded the data science platform that a lot of you listening to this use on the PropTX platform. It's called the Habistat. There's links or just domains here for everything that you can type in if you ever want to see the stuff that I'm kind of currently working on. I also am a columnist for REM, and so I post Treb Market Watch op-ed on the beginning of each month, and a Korea Market Watch op-ed on the kind of the middle of each month, given that Korea data comes out on the 15th of each month. And then I do this call on a monthly basis as well with Real Estate Magazine, just to kind of talk to people in the industry, let you know what I'm seeing, and kind of understand what you're seeing as well. Because to me, I mean, I only do so much transaction work, and a lot of the people that I work with are investors and developers. And so I really only see my portion of the story. And so I like to expand my view, and I always love to hear what everybody else is seeing on the ground there. Um, if you want to work with me, I train investors and real estate professionals in two school groups. And for anybody who's on this call today, I've never done this before, and I'll probably maybe do it like for anyone who attends these calls moving forward. But basically, I'm willing to offer everybody on the call a 2-for-1 deal. So if you sign up for Agent, which by scanning the QR code that you see on your screen, and you let me know, I will give you free access to our investor training platform as well. Both of them have at least one mastermind call per week, so you can meet other agents, meet other investors, talk about what's happening in your market. And we really find that that's a good way to kind of grow by just like collaborating and masterminding together. Um, and uh, the other thing that we also have an event coming up at Calgary Stampede. I'll put a QR code up for that later on when I'm talking about Calgary in this event. But anybody who's in kind of the in Western Canada, or if you're attending in the Stampede, I'm happy to offer you a free ticket to that event as well. Okay, let's get started. So I'm going to talk a little bit about the trade war. Kind of just like we're finally seeing a culmination of a lot of the things. Like it feels like it's over, but it's not really because we did end up still with that blanket tariffs in Canada, and we're starting to see the consequences of it. The biggest one is that Canada's goods deficit is at a record low. So basically, we're in the worst trade deficit with the U.S. That we've ever seen because our exports to the U.S. have sort of collapsed as a result of the tariffs. And you can see there was a big spike prior to that, and that pulled forward a lot of demand. It was a little bit inflationary. It looked good on the business outlook, so everything was kind of looking positive for the past couple of months while people were trying to front run these tariffs with a lot of economic activity, and that's kind of since subsided to the point where we're in a really bad economic setup right now given these circumstances. I don't think that the U.S. will be able to sustain this given Canadian energy and the amount of aluminum and steel that they're importing. I think it'll ultimately appear as inflationary in the U.S. market, but time will tell, right? Um, this is that front loading that I was mentioning. So you saw this huge front loading. Again, that's that spike that you see before the big crash. A lot of people were basically buying and selling things that would later be subject to tariffs ahead of the trade war. And since then, we've seen this huge drop in a couple of key categories: iron and steel, lumber, cars, and aluminum. These are all things that are subject to tariffs when exported from Canada into the US. And so I think it's a decent time to revisit the the visual that I was shared earlier. I think when the trade war kind of first began, um, the Canadian Chamber of Commerce and Oxford Economics both did a analysis on which cities in Canada would be most exposed to a trade war, and sort of this is what they came up with. So you had St. John, obviously the most because they refine all of our oil, as well as Calgary, obviously an oil market. Windsor with the auto, steel, and aluminum sectors. You had Hamilton in there as well with steel. And they kind of ranked it in this like heat map format here, with positive exposure being how markets that would be impacted negatively, and then these negative exposures actually markets that could benefit or have not a super negative impact. Sudbury stands out as an interesting example because it has such a diverse economy, but also because it's a lot of minerals with the Ring of Fire, and those aren't subject to tariffs. They also did a chart that outlines provincial exposure. And so I think that this is kind of like one of the big headwinds for Alberta's really hot market right now, is that if this sustains, it could kind of put a damper on that. But similarly, we also have the not trade war. We have the war going on. It seems to be kind of up and down. There's ceasefire and this and that. But generally, and I'll talk a little bit about it, this ends up being bullish for oil prices, which means that the U.S. Would consume more oil from Canada. If oil prices are high, it becomes more economical to consume and refine Canadian oil. And for those of you who prefer to look at things on a map, this is how Oxford Economics actually mapped that tariff exposure. So you can see that 401 corridor, and we're really seeing this materialize in Ontario already. In Ontario's unemployment rate, which I'll get to, is massively outpacing the remainder of the country. And I think you are already starting to see the kind of knock-on effects of that on Ontario's real estate market. We are seeing increase in transactions, which I'll get to later, but also an increase in listings. And what do people do when they're starting to kind of feel financially stressed? If you're already really at the end financially, and now you're fearful of losing your job, you might think about listing your home, right? And this is where us as real estate professionals in those markets want to be paying attention to what's happening with the market and what people are saying and doing and feeling, because it's our job to help them in like through that big change, and kind of you know use this to maybe de-risk their financial situation a little bit. Um, so unemployment trends I mentioned, Ontario isn't seeing, or sorry, they're seeing an increase in their unemployment rate. Alberta's seeing a larger increase in their unemployment rate slightly. So Alberta's up 70 basis points, Ontario up 60 basis points. National average is up 40 basis points. Saskatchewan, New Brunswick are actually down significantly. And this kind of tracks relatively well with the effective tariff rate. This all comes from National Bank, by the way, on different provinces. Ontario is the most subject to tariffs because we have the auto tariff and we have a lot of auto industry. Everywhere else is less impacted, but Ontario is the most. And so really Ontario unfortunately being the kind of the core of the Canadian economy. And I'm not saying that to be sort of Tony Toronto, center of the universe kind of guy, just mathematically, that's what it is. That could really pull the rest of the economy down if it starts to suffer, and it is, right? So I'd be paying close attention to what's happening there. As a result of all of this, job growth has slowed significantly, and National Bank feels that job growth is actually slower than what the Bank of Canada thinks. So they have the labor force survey here, which is what the Bank of Canada uses, and then they have the official data. The fact that the Bank of Canada isn't cutting tells us that I mean, there's a lot of things that the Bank of Canada pays attention to that might be lagging us as real estate professionals. We could see this one most clearly in their Q1 uh, monetary policy review. They have like a heat map that shows different components of inflation, and the two biggest ones that they show contributing to inflation is increase in mortgage interest and increase in rent. But we all know that rents are falling in Canada in most markets. And so rental inflation shouldn't actually be inflationary. It should be deflationary. Um, yeah, not even disinflationary. It should literally be deflationary. But that hasn't come out of the inflation picture yet. So eventually, Canada will actually be dealing with a lower headline inflation as a result of those components. It could go up from other things. Um, and also once everybody gets past the renewal wall, we'll start to see that mortgage interest component of inflation actually become disinflationary. So the inflation scenario should improve, provided that tariffs and increasing oil prices from the war in the Middle East don't move their way through in an inflationary fashion in Canada. And labor force survey, the gap between labor force survey and official employment data will be a similar fashion. The Bank of Canada is currently operating as though this isn't a really big draw in Canada's economy. Yet, it's a bigger one than that they're observing. And typically, the labor force survey and official data are pretty close. But right now, there's among the biggest gaps that we've ever seen. The only comparable gap would be during COVID. And we kind of know the monetary policy environment that we entered then when, the central bank cut, maybe they overcut, and they responded very swiftly once they saw those results. Um, the unemployment rate continued to rise nationally in May. Again, jobs are a big thing, right? People aren't going to buy houses if they are fearful of losing a job or if they have already lost a job. And it's not just isolated to the factories, steel, et cetera. You can see a ton of industries: agriculture, retail, construction. Construction, we know in the real estate space, is obviously shedding a ton of jobs because a lot of these projects are finishing and we're not pre-selling anything else. Accommodation and food services, business building and other support services, and then manufacturing is obviously the glaringly obvious one. The interesting part, and this is something that I've mentioned for a long time on these calls, is that real estate, finance, insurance, real estate, rental, and leasing, which a lot of which comes from, that's kind of your residential investment category. A lot of this comes from real estate, our business. There's jobs being added. And I mentioned, like, I don't know, early on in these that real estate would sort of be the first industry to recover from a recession. And it's not to say that we're not going to feel the impacts of a recession or that we're not in a recession, but we will recover earlier because we entered into a recession earlier. When the Bank of Canada started hiking interest rates, who felt it first? The real estate industry. Literally overnight, when they fired the first warning shot in March of 2022, prices dropped significantly, transaction volume dropped significantly, and they traded well below the long-term average for basically the last 2 years. There was one period where they jumped up below the long-term average. And that was for like a month. And so we've been in a recession for 2 years, right? Most real estate professionals have seen their income drop by 60, 70%, right? Maybe not all of you who are on the call, because I would consider you keeners and kind of on the forefront of the industry. And that's probably why you're not feeling it. But on average, or at the median in the industry, the real estate profession has seen a significant drop in the market. What happens then is that was when the central bank was increasing interest rates, and we felt the impact most soon. The most immediately. When they start decreasing interest rates, which they have been, we start seeing people come back into the market. They can afford houses again, and that's when transaction activity starts to ramp up, and it is slowly ramping up. It's just not ramping up quickly enough to outpace the supply. How quickly the supply is ramping up. So I'll jump away from trade war a little bit here. and talk about just war, which is, we all know what's going on in the Middle East right now. And there was this concern that this strait called the Strait of Hormuz would be closed, but the Iran has voted um, to close this passage, I think 21 times since 1979 and never actually done it. I think one time they actually did it. So there was fear that that was going to cause some really big impacts on the oil market. And so oil prices spiked pretty significantly. And then Trump announced the ceasefire on Twitter and has put out some pretty interesting media clips since then. But oil prices have basically fallen back to their baseline prior to the big spike from this conflict. You're still seeing them a little bit elevated from the conflict prior. Again, this could be the one thing that maybe saves Alberta if tariffs or offsets the negative impacts of tariffs. But only time will tell where oil prices really fall, but this is one of those factors to really watch with how much is happening right now in Canada, where tons of capital and people are moving to the Alberta market, and I'll get to that a little bit later as well. Um, Bond yields are still stuck pretty high. So this is a 6 month outlook on bond yields. So we're not as bad as we were at the beginning of the year. And bond yields are important to look at because they determine your fixed interest rates. The reason they do this is if I'm RBC, I can either lend money to the Canadian bank by buying a bond, or I can lend money to any of you on this call by giving you a mortgage. And I usually want to charge you about 100 basis point premium, 100 to 200 basis point premium, or spread, they call it. And so you'll usually hear fixed mortgages priced at GOC plus 1 to 200 basis points. That's because RBC is making the decision whether or not they want to give money to the Canadian government at 3% or they want to give money to you at 4%. So that's kind of how fixed rate mortgages are priced based on the Government of Canada bond yield. I will note that CMHC put out some of their mortgage consumer survey and other mortgage market data, and we're actually seeing variable rates eclipsing fixed rates. I didn't put it in this report, but I'll put it in next month's report. But basically, this is consumers telling us that consumers think that interest rates are going to fall because people are either taking 3-year fixed, that's the most common type of fixed right now, or they're taking the variable. And so consumers think that they'll be able to get a lower rate sometime in the next 3 years. Which is important because Bank of Canada does pay attention to what consumer expectations are for rates. The big question mark in regards to whether or not the Bank of Canada can continue to cut is um, what the Fed's going to do. The Fed being the Federal Reserve or the U.S. central bank, and so um, this one's probably more important to pay attention to than pretty much anything that anybody else says in the Bank of Canada until the Fed makes a decision. Right now, there's it was originally priced in that they were going to cut earlier this week or last week at the FOMC meeting. They didn't. It was priced in that they would then cut at the July meeting, and now it's not. Now it's 77% likelihood that they actually just keep the rate where it is at the July meeting. You start moving out. If you go to the CME Fed Watcher tool and you click to September, October, you start to see the likelihood of cutting a little bit higher. But it doesn't seem like the Fed's in a hurry to cut because the U.S. economy is actually surprisingly resilient against all of the crazy stuff that's going on. The one thing that isn't resilient is the U.S. dollar, and so that's been kind of helpful, and it's created a little bit more room for the Bank of Canada to cut because the Bank of Canada is fearful to deviate too far from the Federal Reserve because if Canadian interest rate is significantly lower than the U.S. interest rate, it decreases the demand for our currency. Like the way you can think about it is, if I go buy Canadian dollars, I can get the Canadian dollar equivalent interest rate by investing it by buying Canadian government bonds or whatever. And similarly, I can do the same thing in the U.S. Well, if I can go give my money to the U.S. and get a 5% rate or whatever it is, 4.25 Fed funds rate. And in Canada, I can only get whatever it was, 2.86 or whatever, 3% on the overnight rate. Then I'm probably more likely to go for the one where I'm going to get the higher rate, and that increases demand for the USD and decreases demand for CAD. The Canadian dollar was suffering pretty significantly when the Bank of Canada started cutting way ahead of the Fed. But since the U.S., since all the trade war stuff and everything going on in the U.S., that has sort of slowed the impact and actually given more value back to the Canadian dollar, which has been helpful and maybe has given us a little bit of ability to front run the Fed. Although I don't necessarily, I was fully convinced that the Bank of Canada would cut in the last two meetings just 25 basis points and continue kind of gradually easing down. But I'm no longer convinced of that. I think that they're just waiting to follow the Fed, and they don't really seem to be responding all that much to negative economic data. And I think the big reason for that is they just quite simply don't want to cause any more issues with the Canadian dollar, and they're not super concerned with what's happening in the Canadian economy. I am, but they don't seem to be. As a result of this kind of higher rate environment, we're seeing pretty low more growth in the mortgage market. So we're not seeing a lot of new mortgages being originated. The majority of mortgages are actually coming from renewals. And so this is slow for Canadian banks and Canada's economy on the mortgage side of things. Um, Similarly, we're seeing a huge decrease in population growth, which is sort of the other bull case. Like, realtors often like to lean on one of two bull cases in Canadian real estate. Number one is interest rates are going to come down. Okay, well, hasn't it's kind of stopped happening. Maybe that bull case is gone. The next one is population growth. Okay, well, we're seeing tons of people moving to Canada. Well, we're actually not anymore. Canada's population growth has been falling for 4 months straight, to the point where we're actually potentially seeing net outflows in some provinces, and potentially net outflow in Canada. I know there was a data point that came out from one publication that said that we processed 800,000 in Q1, but like 400,000 of those were renewals or extensions of visas. So it's you got to be careful with which data you're using. And if you actually look at the change in non-permanent resident population on a quarterly basis, this one comes from Millennial Moron, who I'm sure a lot of you follow on all the various social media that he's on. We're actually seeing a decrease in the non-permanent residents. And that comes from two formats. So that doesn't necessarily mean they're all leaving. Some are, like, and quite a few are. And we saw this in the 1990s, and I'll post a chart that's important for you to look at in the 1990s. But a lot of them are actually moving into the permanent residence stream. So they're going from becoming a non-permanent resident to becoming a permanent resident. And so, but that still has them as a statistical negative in the non-permanent resident population. And our winter population growth was basically the lowest that we've seen ever. So, well, not ever, but in recent history. So we're gonna feel this. We already are feeling it. Like, you are all probably seeing it on the ground with rents. Rents have been basically falling off a cliff. We're down double digits in most, if not many many, if not most markets in Canada. I would say that it should this trend sustain. I don't expect it to. I think that the government will start really making an effort to try and ramp this back up once they hit that the non-permanent residents growth target, because right now we're at like 6.7% of Canada's population is non-permanent residents. They want to get that down to 5%. You still need to see non-permanent residents leave on paper to accomplish that goal. They can do that in one of two ways. They can stay in Canada and become a permanent resident, which many do, or they can leave. And a lot of people are electing to leave anyways because the economic prospects in Canada aren't exceptional. And so they choose to leave because they can go make more money maybe back where they moved over from, and they're not a permanent resident. So there's not really a lot of consequences to them doing that. This is a chart I mentioned about kind of looking back at the 1990s. In the 1990s, you saw this huge outflow of non-permanent residents, and there was no policy like what we have right now where they're actually trying to decrease the number of non-permanent residents. This was just by choice, right? People just left because Canada's economy was in a really bad place in the 1990s, and it's in a really bad place today. Interesting to observe that the last time you saw a major spike in non-permanent residents was right prior to that in 1989, and that was the last time we saw a major spike in house prices in Canada as well. The chart on the right-hand side, it's the same chart, but basically the Bank of Canada added rental price inflation to it. So the red line is your rental price inflation, and the green line is your population growth, which is the same as this chart on the left here. You notice that in the 1990s, when you saw population growth decrease, you saw a big decrease in rental price inflation. Similarly, we saw the same thing during COVID, and we'll observe the same. We are already observing the same thing now, as a result of these net outflows of non-permanent residents. I mentioned over a year ago that the Bank of Can or sorry, the Canadian government knew like they could see these trends. You could see, I think it was in Q1 of this year, or sorry, no, October, November of last year, there was a 70% decrease in international student applications. And I had said, within a month, the Canadian government, then the Trudeau government would come out with a policy stating that they were going to cap the number of foreign students, and they did. And the reason was they already observed this economic trend, and they wanted to be able to take credit for it, even though it wasn't a result of their policy. They wanted to say, "Hey, look, we did this thing, and look at what happened immediately." Well, it wouldn't have happened immediately, but that's how they aligned the policies, and most people were none the wiser. Same thing happened in Q1 of this year when they said when we started seeing decreasing numbers in non-permanent residents organically. People were leaving. Like during COVID, there was no limit on non-permanent residents, and during the 1990s, there was no limit on non-permanent residents. People left because the economy wasn't good, and they would rather, if you're going to be suffering financially or not having a job or whatever, you would probably rather do that in the place that you have family, etc., than a place that you just moved to on a non-permanent residence or for a student visa or whatever. Um, and 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 so people were just leaving in that regard. And then the same thing, that was when they announced that they wanted to cap the non-permanent residents. So they're trying to front run these economic trends with policy decisions. And so they're observing and admitting that these are things that are happening right now, and kind of just trying to take credit for it. I mean, smart from their perspective, from policy. I think most people who see it would give them the credit for it, but most of the writing on the wall writing has been on the wall for a lot of this stuff for a while now. Um, if you unpack that population growth, I think looking at the way that it's working on a province by province basis is really interesting. Ontario and BC are actually seeing a decrease in population. And so Ontario, and this is like even with all of we still have permanent residents moving to Canada. We still have, people actually immigrating to Canada. We still have I guess no non-permanent residents because that number is decreasing, but international students, et cetera. And still, among all of that, Ontario actually saw a net loss in population. BC did as well. And the big reason for this is people are migrating to more affordable markets. And the biggest one that they're moving to is Alberta. Over 20,000 people, net population growth. So this is after births, deaths, interprovincial migration, international migration, 20,000 people. Alberta is literally the fastest growing sub-sovereign state on earth right now. And Calgary was the fastest growing city on earth. Um, and like 11% population growth or something like that. And so it stands to reason that Calgary's market is on fire right now, and the Alberta market is on fire right now, or was. It seems to be kind of tapering off. They're sort of hitting that income cap, but this is kind of a big portion of why you're seeing that. Even places like Manitoba and Saskatchewan, people are moving to these more stable job markets to look for better employment prospects because Ontario is bad, but also because in Ontario you can't afford a house, and BC you can't afford a house, and so people are going to places where they can afford a house. This is something that you would see historically. Like Toronto would always play this role of being like almost a transitional or transitory city. New York City in the U.S. is very much like that too, where people will go there, they'll live there for a year or two. They'll immigrate from one country, they'll live there for a year or two, and then they'll realize that it's too expensive. You can't get ahead. This isn't why I came for the American dream or Canadian dream. I'm going to go to a place where I can actually afford to buy a house with my job. And on that note, talking about Calgary, for those of you who are going to the Calgary Stampede or who are in the West Coast, we would love to see you. If you scan this code and you put in the code, or if you scan this QR code and put in the code realist on checkout, you can get a free ticket. And we'd love to see you at the event. That's just as a thank you. I think they're $40 otherwise, but you're welcome to share that code with anybody you want to bring. And we'd love to see you there. It's myself, Nick, my co-host on the Canadian Real Estate Investor Podcast, and our two hosts of the Canadian Investor Podcast, which is the #1 investment podcast in Canada right now. Okay. The rental market so I'm going to talk a little bit about the GTA just because it's where we have the best rental data. Um, rental market has seen record high weekly new rental listing volume for all but 1 week this year. So every week we've been listing more rental properties than we ever have in the comparable week of the year prior, and it's significantly higher. We're up like I don't know 30% in most weeks. So rental supply is massive in the city of Toronto, and this is having downward pressure on rents, which eventually has downward pressure on condos. But there's enough downward pressure on condos, so we don't need to beat them up too much. Interestingly, what we're seeing is, sorry, was there somebody in the chat there? I was just looking at the chat. Was there a question? No. Good.
I don't see a question,
Okay.
but
Awesome.
actually, I'll ask you a question.
Sure.
All the new rental listings, are those due to new completions?
I mean, a lot of them, yeah, but a lot of them are just like people who are so you're seeing a lot of tenants actually shopping around now because if you took a rental in the last 2 years, and again, if you're a real estate professional, this is a good way to kind of advise your clients. You could say, hey, you can probably save money on rent. Do you want to go and get, want to go and rent something? This you could rent the same unit for 10% less. It's a good way to kind of reactivate your clients. Is one of the things that like at Valerie, we're actually building a bot that helps people analyze like their existing rent versus their future rent or potential future rent and whether or not it's worth them even making a move. So yeah, we're seeing a lot. Like we have record closings. I put that in last month's report, but 40 to 50,000 completions this year. So a lot of it's coming from that, but a lot of it's also coming from people leaving, downsizing their living. Yeah, again, you have all these non-permanent residents leaving, people leaving Ontario and going to Alberta. So there's a lot of just regular attrition and churn in the market that's bringing new unit or existing units to the market. Um, One of the interesting things that we're seeing is that we've seen a record number of terminations. So, I mean, again, for those of you who are real estate professionals, you often will see people uh, cancel a listing and then relist it. That's what probably the main reason why we're seeing a lot of terminations. It's not because people are giving up, but you might see some people who are terminating a listing because one of the common themes that we see, Courtney, to your question with a lot of these new condos, is people will close on a condo and they'll try their luck with both options, and this seems to be a lot of the listings that we're taking at our market, which is basically um, you'll see usually you'll see somebody try and list something for sale and for rent. When they do both, they kind of let the market decide what fate that they're going to have. And the way that we're kind of describing this right now, and I put a video out about this recently on my YouTube, was, people are being faced with answering the question, do they want to lose money fast or slow, right? Because if you want to sell, if you're closing on a condo in 2025, there's a pretty high chance that you're in a negative equity position. So do you want to lose 100 or $200,000 today, or do you want to lose? I think the average cash flow negative on a condo is about $600 to $1,000. So do you want to lose $1,000 a month for the next 3 to 5 to 10 years? I don't know how long it'll take for them to make whole, right? And it seems like because we're seeing that record rental listings, more people are trying to lose money slow than lose money fast. Um, the interesting thing, so CMHC just put out their annual report about 4 or 5 days ago, and this is one of the interesting things I found within it was that CMHC is actually ensuring an increasing amount of multifamily, so rental housing. So we're seeing a ton of, I mean, a lot of people are talking about the CMHC MLI Select deals in Alberta, Edmonton, especially. CMHC is basically ensuring more and more rental, multifamily rental through their MLI Select program and CMHC Standard. There's a bunch of other programs that they have to ensure multifamily. Uh, and they're increasing, or sorry, they're ensuring a decreasing amount of homeowner mortgages. So that's your first time home buyer or owner occupied, less than 20% down payment properties. This is really interesting from my perspective because it's actually gotten to the point where that's how much they're insuring like new mortgages each year. Um, and if you actually look at how much they have insured in force, so insurance they're actually holding on their book, um, we've gotten to the point where homeowners are actually less than the amount of insurance that CMHC is issuing on apartment buildings. So and you can obviously see it's a pretty significant increase. And if you look at that on a per unit basis, um, CMHC was always insuring kind of a similar amount, in 2017, 18, 19. So this is number of units. Obviously, rental units are worth a lot less than the homes that people are buying typically. Like a single family home is worth a lot less than, or sorry, a lot more than a single apartment. But now the actual number of units is substantially larger that CMHC is insuring compared to homeowner, and you can really see this sort of like flatlined kind of in 2021 during COVID, and then 2022 is when they came out with the MLI Select program, and that's obviously having a massive impact and a huge adoption, and that's why it's basically skyrocketed since then. So that number is only going to increase. I would expect the homeowner number might increase slightly, but this gap I don't think is ever going to get any smaller than it is right now, unless something massive changes with the way that we're building housing in Canada. What this means is, I mean, if you're looking for a bull case for Canadian real estate, for single family housing, this is it. It's not interest rates, it's not immigration, it's the fact that first time homebuyers are going extinct, and that that we're seeing a decreasing home ownership rate and an increasing rentership rate. It's not to say that I'm bullish on real estate, but that is the bull case in the fullness of time for single family residential. Okay, let's talk about Ontario a little bit here. As the Trailer Park Boys would say, worst case Ontario. Ontario's seen this massively decreased job market compared to the rest of Canada, 60 basis points. Again, Alberta's still worse than this. And a lot of Alberta's increase in unemployment comes from the fact that its population and labor force is growing so much. So that one you kind of have to take with a grain of salt. And this comes from TD. They expect that this is basically going to result in house prices declining in Ontario's housing market, where our sales to new listings ratio is significantly lower than the rest of Canada. And I'll talk a little bit about kind of markets in Canada versus, Ontario, because it's so easy for us to use like the Canadian average when we say like, oh, house prices in Canada are down, whatever it is, almost 2%. But house prices are actually up in every province except for BC and Ontario. So this is on a year over year basis, but Alberta's up 4%, Saskatchewan's up 9%, Manitoba's up 11%, Ontario's down almost 4%, BC's down over 4%. Quebec is up 8%, New Brunswick's up 7%, Nova Scotia's up, 5.5%, PEI's up 5%, and Newfoundland's up over 10%. So BC and Ontario, because the valuations are so high there, and because there's so much transaction activity in those markets, they actually skew the national average down below zero, even though every other province in Canada is actually seeing an increase in house prices. And so you always have to be careful when you're using the national average in Canada, because Canada isn't a monolith, right? Different markets behave very differently, and we're seeing that really, really pronounced right now, where you've got markets like Alberta or even the East Coast where they're pretty strong, and markets like Ontario and BC where they're really not strong. East Coast is a good example. We're calling it the Beast Coast right now because Moncton, Halifax, and Fredericton are leading the country in the largest increase in house prices since 2019. So since pre-COVID, with Moncton leading the pack at 118%. So basically a doubling of house prices, over doubling of house prices since the beginning of the pandemic. Most other markets have not seen as much growth since did see a lot of growth, and then they came back down. Moncton came down a little bit, but not as much. And Halifax, same thing. It did come down pretty violently, ran up pretty violently, came down pretty violently, but still sitting pretty high compared to a lot of the other markets in Canada. Now, the one thing I will say about the East Coast is that like something like 12% of their existing rental supply is under construction right now. So I would say that there's probably a headwind for an oversupply on the rental side in those markets. So that'll probably pull rents down. Might compel some people to not enter the housing market because rents are cheap and they'll just keep renting. It might make some investors' positions challenging, but as it stands, they're looking pretty good on a house price basis. Pivoting back to Toronto's condo market, we've estimated that there's about like 13 billion in pending losses in Toronto's condo market, or unrealized losses. So basically, all but I think 3 projects are closing out of the money in 2025 and 2026. I think there's 3 projects. So the the depth of the redness in this chart is how bad the loss is. Green is positive, obviously. The size of the circle is the number of units in that project. You push that out to 2027, 2028. Basically, all projects are closing in the negative. I don't know what this data point is on the top right hand corner. People always ask me that, but I think it's just a bad data point, to be honest. I don't know a single project that would be 50% profit right now.
Daniel, we did have a question just come in.
Sure.
This person asks, just to confirm, home prices in other provinces are increasing because their listings are getting sold more quickly. Do they have a healthier list to sale ratio than us in Ontario?
Yeah, they do. So they would have a healthier list to sale ratio. They also don't have as much supply because sellers aren't as distressed in a lot of these markets. And they have more buyers because we saw the population growth. Like, so in Ontario, we have a decreasing number of buyers because people are leaving. In BC, we have a decreasing number of buyers because people are leaving. In Alberta, there's an increasing number of buyers, right? And so that's what's so you have more buyers and fewer sellers. So yeah, that's a pretty good description of kind of what's going on there. Um, Still at a national average, if you look at house prices, they're kind of grinding down. And this is something that I've said that this would be the case basically since we hit the peak in 2022. I actually said it before that, but I was pretty famous for calling the top many times too early. But the reality is, I'd always felt that once we came off the top in Canadian real estate, you would see this exact same thing take place as what we saw in the 90s, which was kind of you saw prices drop steeply, you saw a little bit of a bull trap, and then basically prices kind of grinded down over a 5 year period. And that if you really want to get a good understanding for like how this whole thing shakes out in the fullness of time, just look at the 90s. And basically what happened was prices grinded down for about 5 years. They plateaued in 95, 96, and then they slowly returned to their previous peak in by 2002, and that was their nominal peak. If you adjust that for inflation, you're actually looking at going up as high as 2012 to get back to the inflation adjusted peak or the real house price peak. And so I do think this, I can't see a version of Canada's future in which is any different than what we're facing today. So that's kind of what I would be positioning yourself for and positioning your clients for. Like if people are thinking, oh, I'm going to wait till next year when prices come roaring back, they're probably going to be disappointed. I would say that this is going to be a long and slow recovery. That's a good thing, by the way, because it allows people to trade in and out safely. There's no volatility in the market that's catching people in bad positions. And as prices continue to grind down, rates come down, and hopefully wages start to recover as we get out of a recession. Usually you'll start to see activity ramp up. And it's funny because, realtors are always famous for saying house prices are going to go up, house prices are going to go up. But we saw in 2022, what happens when house prices go up, which is that nobody can afford houses, right? And when unaffordability is horrible, then the market drops. But also people aren't doing any deals, and it's really hard to do deals. And so you actually want a market where we have housing affordability, not a market where house prices are going up infinitely. New house prices are actually beginning to stabilize and kind of correct a little bit. They've been more sticky because builders can kind of just take supply out of the market if they don't want to build at a certain price. But we are starting to see house prices come down off the top. Not much, like I don't know, 5 basis points or something like that. Like it's really not meaningful. Not even. It's like I don't know, 1.9%, right below the August peak. Um, Looking at a national level, we did see listings pick up to the point where this is basically the highest number of listings that we've seen since 2020. But if you zoom that out, actually, I'll get to it. But I have a chart kind of showing what that new listings looks like on a long-term basis because it's really not like that wild. Sales have ticked up, but not nearly as much as new listings, and we're kind of been stuck in this. This is that realtor recession I was talking about, where you've kind of seen like really suppressed sales basically since the rate hiking cycle started in Q2 of 2022. And if you look at that measured against the long-term average, there was that one point in time where we jumped up above the long-term average, but we've basically spent since the rate hiking cycle started until now in this firmly in what I would call a real estate recession territory.
Yeah,
Again,
we
if yeah,
definitely, yeah, we had a comment come in about Ontario prices.
mhm.
Somebody says in Ottawa, which is about 10% of Ontario, average prices are up 4 to 5% in May 2024 to May 2025. So the decline in the GTA and Southern Ontario is even worse than Daniel's graph shows.
Yeah, yeah, that's a good point. I think like a lot of markets have in Ontario outside of the GTA and Greater Golden Horseshoe have actually seen some recovery after they kind of bounced off the bottom coming out of that big drop from rate hikes. And so yeah, like the Toronto prices and their impact on the national prices is pretty substantial. Um, Going back to that new listings chart, if you look at this on a long-term basis, you can see again, it's like new listings is pretty significant. So this was the biggest month of new listings that we've ever seen. We did tie this month, like in 2017, when we saw kind of like that mini recession. We saw a little bit of a rate hiking cycle. We were in Trump 1.0, kind of the first round of the Trump administration. There was rate a little bit of rate hikes. We saw the foreign buyer ban. We saw B20 be put in, and so there was this huge kind of micro crash in Canadian real estate. And I wouldn't even say micro, like in certain areas in the GTA, like I think Aurora and Oakville saw like 30 to 40% price drops, which was actually worse than the drops that they saw during COVID, or sorry, post COVID, like the most recent drops. So all of that to say, the national average house price the last time we saw new listings volume this high dropped to about 10%. It's not to say that's going to happen. It's just to say that that's a data point worth thinking about, is that that was kind of the impact of a supply flood, that that was the outcome of a supply flood like the one that we're seeing right now. At the same time, um, again, this is just another version of the same chart there. I think that's your this is just for the month of May. So this is just showing you new listings for the month of May. May is usually the highest listing month, by the way. And then same thing, you can see this is every month. This is supply for the last since 1980, and you can see that 2017 peak number there as well. So we are seeing again like a historic, I would call this supply, a flood of supply, but at the same time, what you would call inventory, which is your not supply, but you're just your standing listings, right? Is pretty much, I don't know, it's a little bit elevated from average. This lower blue dotted line is your average, and then the higher purple dotted line is your is where we're at right now. So we're, I don't know, like 2-3% above the long term average. So we're a little bit elevated in an inventory scenario, but not massively, I would say. So if you kind of look at this, and this is to respond to also relevant to Shamir's comment about kind of on a provincial basis, sales to new listings ratio is kind of historically average. We're not in that crazy period that we've seen basically since the 1990s, but we're lower. So we're sort of above like kind of your 80s periods, but you're but below sort of like the long term market that we're used to since the 1990s, right? Where we, and especially, and this is just for months of May. And this is your May months of inventory. Same thing, kind of we have a rising months of inventory since we hit a low in 2021, but we're not really that bad compared to a 1990s market. We're still below even your 2008 market and your 2017 market. So months of inventory is probably like the one kind of more optimistic metric right now. The big thing here, then this is why I think policymakers care so much about this, is real estate is a huge share of the provincial economies for most provinces, and it's a growing portion of all of those economies in everywhere except for Saskatchewan, and that's because Saskatchewan has just been absolutely crushing it with their natural resource expansion, like potash and things like that, and putting in more and more mines. Um, their National Bank observed this kind of variation in home sales. Ontario actually saw a 10% increase in home sales, and this is all due to the fact that house prices have come down in most major markets significantly enough that people can start affording them. You've seen increases in home sales in PEI, Saskatchewan, Alberta, Canada as a whole, and Newfoundland, and decreases in BC, Quebec, New Brunswick, Manitoba, and Nova Scotia. Um, Same thing, active. So this is kind of similar to sales to new listings, but Ontario is really the only market where you're actually seeing, or Ontario and BC are the only markets where you're seeing sales to new listings, or sorry, sales to active listings looser than average. And a lot of that's because active listings are piling up. And that's simply because people in Ontario and BC are over levered. They can't afford it anymore. And a lot more people are selling and fewer people are buying. Even though we're seeing that 10% increase in sales, it's because you're coming from a low base. We saw really low sales this time last year. So that's everything I've got for you today. I'm happy to do questions. I also just figured I'd pull up this slide for anybody who wants to join our Agent Academy for Realtors. Again, happy to do a 2-for-1 deal for you for anybody who joins today from this call. The reason I'm only doing it for today is we honestly do just let in a limited number of people at a time to make sure we can handle the volume of new students that we have. The Agent Academy, we teach real estate agents how to leverage AI to get to the next level of their real estate business, whatever that might be. You could be a part-time agent who's trying to get full-time. You could be a 250 a year agent who's trying to get to 500. You could be a leasing agent who's trying to become wants to focus on sales. You could be a buyer agent who wants to focus on listings. We help agents leverage technology to get to that next level. And realist.ca, for those of you listening to the podcast, I'm sure you're familiar with it. It's a national network of over 150 real estate investors. We mastermind on a regular basis and share deals, underwrite deals, build our investment strategies together. And so, again, if you scan the QR code, register for agent, anybody who I see that joins the Agent Academy today, I'll ask you for an email and I'll send you an email to join realist.ca for free. So scan the code. I'd love to see you in there, and I'm happy to answer any questions that anybody might have now.
Great. We do have two questions waiting.
For
The
sure.
first one is, do you think the feds are going to remove the foreign buyer ban anytime soon?
No, I think that they'll let it expire in 2027. I thought they'd let it expire in 2025, but they didn't. They renewed it. But I do think that they will. I think that they'll kind of quietly just let it fizzle out because they renewed it from 25 to 27. And then once it expires in 2027, I think they'll just not renew it again because I think that that will add quite a bit of stimulus to the market. That being said, one policy that I think you should be paying attention to, if you're looking for kind of like that catalyst that could help the market recover, is the stress test. So OSFI's been studying the stress test. We actually just did a podcast about this. But basically, OSFI's been studying the stress test for since November of last year, October, November of last year. It was actually longer than that, but they released some of the results of the test in November of last year. So the way that they've been doing it is they're running the stress test, but they're also running this portfolio loan limit where basically banks are capped at a total of 4.5x income. So like if you take all of the incomes of all of your borrowers and all of the loan size of all of your borrowers, that number can't be more than 4.5x. And I think it's only 10% of your book. It might be 18. I can't remember the number, but only a certain percentage of their book can actually have a loan to income above 4.5x. And so if that experiment proves helpful and valuable in forcing the banks to actually be the ones to enforce the risk rather than the borrowers, then OSFI did this whole experiment with the objective of seeing whether or not they could achieve the same result with a policy that forces banks to be stress tested rather than borrowers to be stress tested. And so if and when they get the favorable result, which I would expect that they will based on everything that I've been hearing, you will likely see a removal of the stress test in Q1 or Q2 of next year. And what that would do is it would disproportionately positively impact first time buyers because anybody who is, or first time, or anyone who's only buying one house, it would take buying power away from investors who are now going to be limited by that 4.5x income, and it would just redistribute that buying power to first time and second home buyers. And so you're the clients that most people represent. People are buying and selling their own house. They're primary residence purchasers. And so I think that is probably a more worthwhile policy to be paying attention to in the short term. But yeah, I do think that they will get rid of the foreign buyer ban. I don't know if 2027 is anytime soon, but that's when I expect that they'll get rid of it. And the next question.
Yeah, so this next viewer has two questions. I'll start with the first one. That is, what is the forecast for single-family homes in the next 5 years in Ontario, more specifically Ottawa? Do you anticipate lower building rates in this segment to push prices up in the near future?
Um, Yeah, I would say that Ottawa probably has one of the more optimistic forecasts. Like I think that prices could move up at least with the rate of inflation there, simply because we're seeing job losses in every other sector, and but the government's not getting any smaller anytime soon. I guess it is a little bit like we have seen a little bit of downsizing, but generally, once policymakers are willing to admit that we're in a recession, they're usually going to spend a lot of money to try and stimulate us out of the recession. And so I would expect that the government will benefit from that. And you'll see more government hiring, more money in a market like Ottawa. So that would be reason number one. Reason number two is they didn't see, I mean, Ottawa corrected pretty hard coming out of COVID. And so I think that they kind of found a lower, they kind of found the bottom quicker. And so there's that piece, but also the final piece is like, if you just look at the jobs and the prices, the wages that you would see in Ottawa relative to income are actually higher, and house prices ultimately like how much they can go up is based on how affordable they are to the average person. And when your median earner income in a market like Ottawa, I think it's the highest. It's one of the most affordable markets in Canada based on price to income, simply because everybody's making a government wage. You know, each household's making whatever $103,000 or whatever that exact number is that they all make, and so your house prices are significantly lower. So wages are higher than a city like Toronto. House prices are already lower. I would say Ottawa gives me a little bit of a an optimistic outlook probably for the next 5 years. I don't think any market in Canada is really gonna like rocket ship, but I think Ottawa is more likely to grow in that kind of slow and stable. Like I would just say the forecast that I gave you for the entire market in Canada, I would just say Ottawa is a little bit like they're kind of already starting that slow, steady recovery.
Okay. And that viewer also asked, what are your views with CMHC's supply need in terms of building units to over 400,000 a year? Do you think that target is a stretch? I believe that would be referring to the report that CMHC came out with last
Yeah.
week, saying that 400,000 units a year would help restore affordability in Canada.
Yeah, I mean, I think that I mean, look out below in the housing market if we actually build that many units. I think like the what they're dismissing because we don't have the most recent census data is that Canadians have already been responding to unaffordability by like consolidating into more dense households. So the number of people per dwelling is actually increasing in Canada. So the square footage per capita, let's call it, is actually decreasing. So we went from having like the third largest houses in the world, or the third largest square footage per capita in the world, to we'll probably still be up there, but like that number is going down. You're starting to see more people go into a house. I don't think that like yeah, people will probably stop maybe we'll start to see households deconsolidate and kids will move out of their parents' basements and whatever if they hit 400K a year. The reality is they're never going to hit 400K a year. I don't actually think we need 400K a year, especially if population growth is falling at the same time. And if we see population growth falling and even if we see 300,000 houses built in the next year, I mean, your housing market would be completely unrecognizable, and there would be very little, there'd be next to no price growth, if not prices falling in almost every market in Canada. The one thing I would say is that people kind of need to look at how different markets are delivering supply. So, like I mentioned, Edmonton MLI Select as an example. Alberta is very efficient at delivering supply. That's why their house prices haven't been gone crazy, right? Whereas Ontario is very inefficient at delivering supply. And Ontario has really high population growth, and Alberta has really high population growth. So why aren't Alberta prices as high as Ontario? Well, because they're building, and so a lot of this needs to be broken out into a province by province basis. You can't just say, okay, 400K units for Canada. What impact will it have? It's like, you know, I think Alberta is probably reaching the potential where it's overbuilt. And I actually think, no offense to the people who are doing these deals, but there's a lot of these MLI Select deals are probably at risk of seeing vacancy rates blow up their pro formas and falling rents blow up their pro formas for the people who have been overpaying for them. And so I think that, you know, you really have to look at it on a different market by market basis because different provinces build more efficiently.
Okay, we've got a couple more questions here.
Sure.
The next one is, who was your mentor or coach to get you here today?
I guess I would say my parents, to be honest with you. Like I started in their real estate business like over 10 years ago now, and they really just helped me to, I don't know, like really become passionate about the craft and also understand all the factors and skills that I needed. Yeah.
Okay, cool. This is an interesting one. With a 4-day return to office policy being mandated by some major banks, does that put more pressure on real estate prices in major cities? And does it also reduce prices in the suburbs?
For sure. Yeah. I mean, I think you can already see this happening. Like, I mean, there's a reason 905 house prices are falling faster than 416 house prices in the GTA. Um, you know, you're everybody left assuming they'd never have to go back to the office and got caught it. You saw it in cottage country first, right? All those people when they were mandated a 1 or 2 days back in the office, they were like, screw this, I'm leaving Muskoka and I'm going to move back maybe a little bit closer. Now you're seeing the same thing kind of happening with a lot of those people who suburbanize. So you're starting to see what we're calling a reurbanization of demand, right? We're basically, yeah, core properties downtown detached isn't invincible, but it's definitely faring better than your 905 detached. So absolutely, yeah, the question, like way that you phrased the question, everything that you asked, if that's happening, that's all happening for sure.
Okay. Well, gosh, I think that's all the questions.
Okay,
Haven't been any more come in about 5 minutes, so
perfect.
looks like a good time to sign off.
Amazing. Okay, well, yeah, I really appreciate your time and can't wait to see you again next month.
Yes, we'll see you again next month. See you in
Okay,
July.
thanks everybody.
Bye, everybody.